The deal has been 5 years in the making, and according to analysts, the logistics are compelling.
If you look at this deal and you put a kind of geographical template over the two, you'll find there's very little overlap anywhere in the world, other than in the US, where AB and InBev has got almost 50% of the beer market, SABMiller has got about 30%, and again in China, where SAB's got about 23% of the market and AB's got about 15% of the market.
While the initial offer was rejected by the SABMiller board, this may be more about posturing in an effort to hold out for a higher premium.
You must remember that the people behind AB InBev are the 3G Capital guys. So they're a bunch of Brazilian private equity guys who were funded by, believe it or not, including Warren Buffett on a big food deal that they did. So there certainly is the money there, but it's whether or not they want to pay a huge premium over and above what the first rounds of talking has done.
This is a great deal for SABMiller shareholders, at least in the short to medium terms, in the sense that the current share price that's on the table, the deal that's been offered, £42.15, represents about a 44% premium to the so-called undisturbed price.
But it seems at least one South African institutional investor is not that excited about the deal. The Public Investment Corporation issued a terse statement on Wednesday evening, saying it had seen the offer and was a little concerned that local investors wouldn't be able to benefit from future growth of SABMiller.
Last I checked, more than 80% of the ownership of the shares of SABMiller were in the London register. So it doesn't really matter what the South African shareholders say as a collective. I suppose it does at the fringes, but because of exchange controls, obviously we can't own scrip in different geographies. So if that had to change, then they'd probably be open to the deal.
We have to bear in mind that SABMiller actually changed its domicile back in the late 1990s, 98, 99 sometime. It is a London-listed company. Today, the South African share register accounts for less than 7% of the total equity.
But is there an investment case to be made if the deal goes through, even though the final premium may be higher than what's currently on the table?
It'll create a monster company that's bigger than Procter & Gamble. It will be the biggest consumer services company in the world, with EBITDA of around about $25 billion and have a market cap of about $275 billion. It is going to be a huge behemoth, and because of that, it's going to take a lot of time to bed down.
This is going to be a good deal for those people who are still invested with either one of the two stocks that will potentially merge in the future. We'll have to wait and see how this plays out in terms of the regulatory environment though. Not so much in South Africa, but in the UK and in the US. I'm Angelo Coppola for CCTV in Sandton, Johannesburg.